The firm, no surprise, they thought themselves invulnerable, right? But there were some hiccups, like the near collapse of long-term capital management, LTCM, you may have studied that, where they took big positions in Russian bonds. Russia then defaulted, and this had enormous ripple effects, including Lehman, where Dick Volt had to defend rumors that there was a huge cash crunch at Lehman as a result. Share price plummeted and then worked its way back up. Alliance with Bank of Tokyo Mitsubishi. In 2001, pressure to cut costs. And it's interesting for investment banks, they're kind of like football teams, right? The investors may not do very well, but the players do extremely well. The 51% of the expenses of Lehman Brothers were staff compensation. You know, this is an investment banking model. You have to pay these people a lot of money to incentivize them to perform. And given the pressure to cut costs, he took the decision to pay staff less in cash and more in stock rather than lay them off altogether. So that makes him sound like a very kind and gentle individual, but I think he was very pragmatic too. So they established the Wealth and Asset Management Division, acquiring Neuberger Berman and others. And in 2007, their net revenues were at record highs, net income and earnings per share. For the fourth consecutive year, highest volume of trade on the LSE for the third year in a row. It looked like they could do no wrong, right? Kind of like the Enron and WorldCom stories previously that we saw. They reached to fall. September 15th, 2008, a date burned into my memory. The date Lehman filed officially for bankruptcy, over $600 billion in assets, over $600 billion in debt. So think about the leverage of this firm. It was incredibly leveraged. The largest bankruptcy filing in history, far surpassing examples such as WorldCom and Enron. The fourth largest U.S. investment bank. This is bound to have effects elsewhere in the world, right? 25,000 employees. Also the largest victim, which is to a large extent brought on itself, of the U.S. subprime mortgage-induced financial crisis. This is what did Lehman in, I think. This is what they regarded as the engine of their growth going forward. They couldn't compete with Goldman in equities. They couldn't compete with houses like Morgan Stanley and Merrill in fixed income. So we're going to carve a niche for ourselves in subprime, which looks like a promising market. Lots of stuff being issued there. It's very profitable. Totally ignoring the risks that came with it. Because what were they doing? These mortgage lenders were lending to people who had no visible means of paying these mortgages back. And when that became apparent, things rapidly unraveled. A seminal event greatly intensifying the crisis, contributing to loss of almost $10 trillion in market capitalization from global equities in October, the biggest monthly decline on record. So they certainly made their mark. On the Saturday, Tim Geithner, who was president of the New York Fed, called a meeting about Lehman's future, including emergency liquidation. The bank had been in talks with Bank of America and Barclays for takeover. Both of them ultimately declined to buy the bank. I mean, Barclays picked up a lot of employees in the U.S. on the cheap, so they got a good deal. ISDA offered an exceptional trading session on Sunday to allow market participants to offset some of their positions, because Lehman was trading with everybody around the world, right? There's practically no financial institution or corporate that was untouched by this. The following day, we had the official announcement of the bankruptcy. An already distressed financial market began a period of extreme volatility. The Dow experienced its largest one-day point loss, largest daily point gain, largest intraday range, more than 1,000 points. The markets were going like a yo-yo. Everyone was panicking. They didn't know what to do. And we had the perfect storm, as it's been described, of economic distress factors. Eventually, a $700 billion bailout, Troubled Asset Relief Program, TARP for short, was prepared. The Secretary of the Treasury, Hank Paulson, was instrumental there, approved by Congress. And later on in November, the Dow eventually closed at a new 6-year low of about 7,500. Now, Hank Paulson was also instrumental in the decision not to save Lehman Brothers. And I'm convinced that part of this stemmed from the fact that, what was his prior job? He was head of Goldman, right? So he and Dick were not necessarily cozy together. They had been bitter rivals years ago. And so Hank saw his chance, if you will, to get back at Dick. I think there were other good reasons. This was would have been a huge bailout. They also had Freddie Mac and Fannie Mae to deal with, and there's only so much to go around. But let's say it was not a good contributing factor because they had bailed out Bear Stearns previously, right? Lehman, however, was bigger and arguably more arrogant. But you know, these 5 CEOs who basically drove their companies into the ground, each of them over that period took home a total of $2 billion. What were they being paid for? We had the U.S. housing boom going on in the early part of the century. It was a bubble, really, which was about to burst at any time. And in the midst of all this, Lehman keeps acquiring subprime mortgage lenders like BNC and Aurora, specializing in loans made to borrowers without full documentation. You're asking for trouble in something like that, aren't you? But it was very profitable. They saw the dollar signs and very little else. It seemed to be a good strategy at first, right? They were realizing record revenues. Their capital markets business was growing exponentially. They were securitizing these mortgages in order to resell them, which they did in part, but part of the problem was they had to keep a large chunk of them on their own balance sheet because they just couldn't sell them. These were very toxic assets. And in 2006, again, record profits each year, 2005 to 2007, culminating in a record more than $4 billion in 2007 on revenue of $19 billion. Right? What could possibly go wrong? Colossal miscalculations. Okay, it was in February 2007 where they reached their high, almost $60 billion in market cap. But by the first quarter of 2007, and they would have reported their first quarter, a little bit after that, cracks in the housing market were becoming apparent. Defaults on subprime mortgages rose to a 7-year high. These borrowers realized that they had to make these monthly payments. The rates were going up. They could no longer afford them. They just handed the keys to the house back to the bank and walked away. Sorry, not my problem anymore. And who's left holding the bag? The banks and the investors. On March 14th, there was a day before a huge one-day drop. Still record revenues posted for the first quarter. And the CFO at the time said risks posed by rising home delinquencies were well contained and would have little impact on the firm's earnings. Of course, he stepped down shortly after that. He also said he didn't foresee problems in the subprime market spreading to the rest of the housing market or hurting the U.S. economy. And apparently Ben Bernanke, chairman of the Federal Reserve, was of the same opinion. He didn't regard it as a bubble. He regarded this as robust growth. He was totally wrong. What else? Oh, the CFO to follow Chris O'Meara, who was CFO at the time, was a former banker whom I worked with, a woman called Erin Callan, and an effective banker, but totally out of her league when it came to being a CFO. She could not communicate properly with investors. She didn't understand all the dynamics, and she was one of the victims of this whole process as well. In fact, the head of investment banking at the time stepped and said to Dick, "You're making a big mistake by making someone like that the CFO. Again, you're just asking for trouble." And you may have seen representations in the boardrooms in these films as to what was going on, but very sad.